3M, stock ticker MMM, has taken a massive drop over the past few days after reporting the latest quarter's earnings. Now, this company is a dividend king with over 50 consecutive years of dividend increases and has a very high starting dividend yield sitting at 6.24%. So in this video, we need to jump into all the details with what's going on with this company and if it's a good stock to consider buying at its current prices. And like always, if you'd like to join a community of dividend investors and get access to any of my spreadsheets, you can head over to my Patreon page at the link in the description. So let's go ahead and jump into it. We can see 3M over the past year down around 24%, but if you look at just the past 5 days alone, now down over 11.61%, and we can see the huge drop from the time that they reported the latest quarter's earnings. Let's go ahead and jump into that earnings report. We can see they had a slight beat on the earnings per share, 242, which was a beat by 11 cents, but they had a slight miss on the revenue. So overall, on the surface level, it doesn't look like a terrible report. So let's dig into this a little bit more and see what's going on here. The big problem was they issued future week guidance with the company. Now, there's a few different reasons for this. First, we can see organic sales are continuing to decline. And if we jump back over to Seeking Alpha, let's go ahead and jump into the income statement and take a look at this. First off, we can see the revenue for this company over the past decade has been pretty stagnant. Obviously, you typically want to see growing revenues, but here's where the big problem comes in. If we look at the cost of revenues right here, we can see while the revenues have remained steady, the cost of revenues have slightly decreased, meaning their profit margins are declining. So when you have stagnant revenues and declining profit margins, that's obviously not a good sign. And if we jump over to the profitability tab, we can see gross profit margin for the trailing 12 months sitting at about 43.46%, but their 5-year average a little bit higher than 46.89%. Again, looks like they are a victim of declining margins, not something you want to see. Now we can see the second reason is probably the biggest reason, and that is some of the legal troubles that the company is currently facing. And this has been an ongoing battle with the company for quite some time now, but let's go ahead and put some numbers to show you just how big these legal troubles are. First off, we can see again facing major litigations, including a $6.01 billion settlement for defective earplugs and a $10.3 billion settlement for water contamination. So a lot going on in the legal department with 3M right now. And again, if we jump back over to the financial statements and jump over to the balance sheet, let's go ahead and look at total current assets. We can see total current assets sitting a little over $16 billion, but again, the current settlement values they're looking at is also a little over $16 billion. So they are definitely in quite a bit of a cash bind right now. And then the last bit of news we need to look at regarding 3M is they soon have a healthcare spinoff, and this is projected to take place in the first half of 2024. Now, this is not necessarily new news. It's been expected for a while now, but the date of the transaction has continued to be pushed back. So yes, quite a bit going on with 3M on the news front right now. And we'll come back to some of that here in just a little bit, but let's go ahead and talk about the dividend again for a moment. Now, like I mentioned earlier, very nice starting dividend yield sitting at 6.24%. And like I also mentioned earlier, this company is a dividend king with over 50 consecutive years of dividend increases. This company has a phenomenal dividend history, and we can see 10 years ago, it looks like they are paying out around 86 cents per share every single quarter, and jump forward to now sitting at $1.50. That's decent dividend growth over that time period. If we look at these dividend growth rates, we can see the 10-year dividend growth rate actually pretty solid, sitting at around 9%, but the 5-year and the 3-year dividend growth rate not looking good. The 5-year sitting at around 2% and the 3-year sitting at just 0.7%. And again, I've said this before, but anytime you have a company that is increasing their dividends below the rate of inflation, that company is technically paying out less in dividends every single year. So it's really not just enough to increase dividends every single year. You want to see raises above the rate of inflation, and 3M has really struggled to do that over the past few years. Now, what we really need to talk about is how safe are these big dividend payments this company is currently paying out. So if we jump over to the dividend safety tab, what I want to look at personally is the cash flow payout ratio. How much of their free cash flow is being used to pay out dividends? And forward looking, it looks like it's sitting at around 59%. So let's go ahead and break that down just a little bit more. Again, if we go to the summary tab, we can see the current dividend rate for this company is $6 per share. That means they need to generate $6 of free cash flow per share for their free cash flow to completely cover the dividend payouts. So if we jump over to the financial statements and click on statement of cash flows, if we scroll down here to the bottom, we want to find free cash flow per share, and right here we have it. And we can see for the trailing 12 months sitting at about $9.14. So yes, this company is currently generating a decent amount of free cash flow to pay out their dividends. Now here's where the big problems kick kick in. Yes, their free cash flow does cover their dividend, but we can see over the past 4 or 5 years that free cash flow has been declining. So it makes sense that their dividend growth rates have been very, very low over the past few years. In fact, I would venture to say the only reason they've been increasing those dividend payouts is so that they can continue to be considered a dividend king. But with the ongoing lawsuits that this company is currently going through and the declining cash levels and declining margins, I would have to say this dividend does appear to be at risk. Now, I don't think cutting the dividend is something this company has to do right this moment, but it is something the company may consider doing in the future to improve their balance sheet. Now, with all of that being said, with there being blood in the markets, is now a good time to consider adding 3M to your portfolio? Is it trading at a good price? And to answer that question, let's go ahead and jump into my stock valuation spreadsheet. Again, you can download this on my Patreon page at the link in the description. And if we come up here and plug in MMM and hit enter, you can see all of this data will automatically load in. We've already touched on the dividend data quite a bit. We can see the 20, 50, and 200-day moving averages all down quite a bit. Analysts have a target price of around $107.76, institutional ownership 67.3%, and a beta sitting right at 1, so the volatility of this company should follow that of the market pretty closely. Now, the first valuation we want to look at is Graham's valuation. Now, this is basically valuing a company based on their projected earnings per share growth. And if we jump back over to one of the spreadsheets that we looked at earlier, talking about the recent earnings report, if we scroll down, we can see 3M did give us some earnings guidance. They're expecting around $9.35 to $9.75, which was a little bit lower than the estimates of $9.81. Again, a big reason we saw a major decline in the share price. But with this information that we saw from the latest earnings report, we can fill out some of the data in Graham's valuation. And I'm going to stay on the lower end of those projections and go with $9.40 earnings per share, apply a low growth rate projection of 3, multiply that by 4.4, which is the average yield of AAA corporate bonds, and then divide by Y, which is the current yield on AAA corporate bonds. And once we've done all of that, we come to an intrinsic value of right at $88 per share, again, a little bit below that current trading price. Now, the next valuation we'll look at is going to be our discounted cash flow analysis. And basically, we're valuing the company based on how much free cash flow they're going to produce in the future. And again, you can see I'm projecting a low free cash flow growth rate for this company. And we use that information to find the future free cash flows and the present value of those future free cash flows. Add those cash flows together, add the cash and cash equivalents from the company, and subtract out the total debt to get their equity value, divide by shares outstanding, and we come to a discounted cash flow price per share of right at $102 per share. So it does look like their free cash flow valuation is a little bit higher than that current trading price. Now, the next valuation we typically look at is the multiples valuation. I don't think it's a good valuation model in 3M scenario, so we're not going to use it today. Let's go ahead and jump forward and look at our dividend discount model. Now, again, this values a company based on how much they pay out in dividends and how much those dividend payments are increasing. So what I've done is I plugged in those quarterly dividend payouts over the past 4 or 5 years so we can see those yearly dividend payouts and the year-over-year dividend growth rates. And again, it has slowed down dramatically. And in this scenario, I'm projecting a dividend growth rate of around 1%. I think that's going to be 3M's target growth rate. And with a discount rate of 8%, you can see we come to a dividend discount model price per share of $86.57. Now, again, it will be interesting to see management's approach to capital allocation with some big expenses coming up and seeing if cutting the dividend is something they would consider. That's something we really don't know at this time. But if we go ahead and jump over to the output tab, we can see our 3 valuations, Grams at 88, DCF at 102, and dividend discount model at $86.57. And when we average those 3 together, we come to an intrinsic value $92.19, just below the current trading price. It's very close. So with a 20% margin of safety, you could see the acceptable buy price at $73.75, 10% margin of safety, $82.97. So it looks like, again, it's pretty close to fair value. Now, my current problem with this company is it's hard to see the path to growth moving forward when they're using so much of their free cash flow to pay out dividends, and they also have some major expenses coming in very, very soon. And with the cash levels on the balance sheet not necessarily looking great, that does lead me to believe this dividend could potentially be at risk. Maybe not for the next few years or so. We don't really know what management's approach will be, but I do think it's a possibility. So while that dividend history is attractive and the starting dividend yield looking very nice at 6.24%, this may be a company you want to be careful when considering adding to your dividend portfolio. But there you go. There is an analysis on 3M stock. Go ahead and let me know what you think of this company in the comments down below if you plan on buying and selling. And like always, if you'd like to join a community of dividend investors and get access to any of my spreadsheets, you can head over to my Patreon page at the link in the description. So that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.